Eldorado Gold Corporation has emerged as a compelling mid-tier producer with a diversified geographic footprint spanning Canada, Turkey, and Greece. Eldorado is nearing a definitive inflection point in its corporate life cycle. The primary catalyst for this transition is the advancement of the Skouries project in northern Greece, a world-class asset that is poised to fundamentally alter the company's production profile, cost structure, and revenue diversification. This analysis provides an evaluation of Eldorado Gold's operational performance, financial resilience, mineral endowment, and strategic positioning, offering a nuanced perspective on its investment potential in an era of sustained high commodity prices. The historical trajectory of Eldorado Gold is defined by a decade-long effort to de-risk its Mediterranean portfolio while maintaining a stable production baseline from its North American and Turkish assets. Following the 2011-2012 acquisition of European goldfields, the company inherited a suite of high-potential but complex assets in the Chalkidiki region of Greece. For years, these projects remained mired in regulatory uncertainty and localized opposition. However, the 2021 amended investment agreement with the Greek government marked a watershed moment, establishing a modernized legal framework and providing the clarity necessary to restart construction at Skouries. Concurrently, the company has demonstrated operational discipline in Canada through the successful integration of the Lamaque complex, which has provided a high-margin, stable jurisdiction offset to its international development risks. As of late 2025, the company stands on the precipice of a significant production expansion, with copper set to become a secondary pillar of its revenue stream, aligning the company with the long-term thematic of global electrification and the green energy transition. Geographic footprint and jurisdictional analysis. Eldorado Gold's strategic differentiation lies in its ability to navigate diverse mining jurisdictions, each presenting a unique combination of geological potential and operational challenge. By maintaining a presence in Canada, Turkey, and Greece, the company balances the lower-risk, higher-cost environment of Tier 1 mining districts with the high-grade, higher-reward potential of the Tethyan Belt. This jurisdictional mix is critical for risk mitigation, as it ensures that the company is not overly exposed to the regulatory or social shifts of a single nation. In Canada, the company's focus is centered on the Abitibi Greenstone Belt in Quebec, specifically the Lamaque complex. This asset provides a foundational layer of stability for the portfolio. Quebec remains one of the world's most favorable mining jurisdictions, offering a combination of transparent permitting, established infrastructure, and a skilled workforce. The Lamaque mine has consistently outperformed expectations since reaching commercial production in early 2019, providing the free cash flow necessary to support Eldorado's international development projects. The company's continued investment in the region, including the acquisition of additional shares in Amex Exploration and the focus on the Lamaque deposit, signals a long-term commitment to Canada as its primary hub for low-risk growth.
Turkey represents the historical engine of Eldorado's production, anchored by the Kışladag and Efemçukuru mines. The Turkish mining sector has historically been supportive of foreign investment, though it has recently introduced structural changes that investors must monitor closely. Specifically, the expansion of the state royalty regime and the implementation of Law No. 7554, which centralizes permitting authority under the presidency, indicates a move toward more active government management of strategic resources. While these changes have increased the cost of operating in the country, the geological quality of the assets remains exceptional. Kışladag, a large-scale heap leach operation, has celebrated the production of its 4 millionth ounce of gold, a testament to the longevity and scale of the Turkish portfolio. The company's ability to successfully offset depletion at Kışladag through mine plan optimizations and exploration success underscores the maturity and reliability of its Turkish operations. Greece is the setting for Eldorado's most significant value creation opportunity. The Chalkidiki Peninsula, home to the Cassandra Mines Complex, Skouries, Olympias, and Stratoni, contains one of Europe's most significant mineral endowments. Historically, Greece was viewed as a difficult jurisdiction due to environmental protests and bureaucratic delays. However, the current Greek administration has prioritized foreign direct investment and recognized the importance of the mining sector for national economic development.
The involvement of the European Bank for Reconstruction and Development as a strategic financier and equity holder in Eldorado further de-risks the Greek operations by providing a layer of institutional protection against potential regulatory reversals. The successful advancement of Skouries, which reached 73% construction completion by the end of the third quarter of 2025, suggests that the Greek risk is being successfully managed through transparent sustainability practices and robust community engagement. Operational excellence and producing asset deep dive. The company's ability to fund its growth is entirely dependent on the operational efficiency of its current producing mines. In 2025, Eldorado tightened its production guidance to between 470,000 and 490,000 ounces of gold, reflecting a steady performance despite localized challenges. The interplay between these assets reveals a company that is capable of managing complex metallurgical and geological environments while maintaining a focus on cost containment. The Lamaque complex remains the standout performer in the portfolio. In the third quarter of 2025, the site benefited significantly from the processing of a second bulk sample at the Lamaque deposit, which bolstered gold output and provided critical data for future mine planning. The integration of Lamaque into the broader Lamaque strategy is a second-order insight into Eldorado's focus on longevity. By utilizing existing mill capacity and underground infrastructure, the company is effectively lowering the capital threshold for future expansion in Quebec.
The recent 25% increase in mineral reserves at Lamaque reinforces the belief that this complex will remain a cornerstone of the company's production for the next decade. Furthermore, the high-grade nature of the Triangle and Lamaque deposits allows for robust margins even in an environment of rising labor and energy costs in Canada. At Kışladag, the narrative is one of maturity and modernization. As a low-grade bulk tonnage operation, the mine relies on the efficiency of its heap leaching circuit. In mid-2025, production was bolstered by higher grades and the accelerated drawdown of inventory from the leach pads, though the third quarter saw some normalization due to longer leach cycles. The deeper insight here is that Kışladag acts as the company's volatility buffer. Because the operational costs are relatively fixed and the mine has a long reserve life, it provides a predictable stream of cash flow that is less sensitive to the exploration failures that can plague smaller mining firms. The mine's transition to deeper ore bodies and the optimization of stacking plants are essential for maintaining this stability as the asset moves through its second decade of life. Efemçukuru serves as a high-margin complement to Kışladag in Turkey. This underground operation is notable for its consistent delivery of high-grade gold concentrate. The recent extension of the mine life through the inclusion of the Kokarpınar South deposit demonstrates the company's success in near-mine exploration, which is far more capital-efficient than greenfield discovery. By extending the life of an asset with already paid-for infrastructure, Eldorado is maximizing the return on its historical investments. The site's contribution of approximately 21,000 ounces per quarter provides a reliable, high-margin component to the consolidated Turkish production profile.
Olympias in Greece remains the most operationally complex asset in the portfolio. As a polymetallic mine producing gold, silver, lead, and zinc, it is highly sensitive to metallurgical recoveries and the efficiency of its flotation circuit. Throughout 2025, Olympias faced challenges ranging from mechanical failures to lower-than-expected throughput. The significance of Olympias extends beyond its gold production. It is a critical source of byproduct credits that theoretically lower the company's consolidated all-in sustaining costs. The ongoing efforts to expand the mill to 650,000 tons per annum and stabilize the flotation circuit are essential for turning Olympias from a volatile producer into a steady cash flow generator. The long-term reserve life of 15 years suggests that management has the time necessary to resolve these technical hurdles, but in the near term, Olympias represents the primary source of operational uncertainty for the company. The Skouries project, the definitive value catalyst. The investment case for Eldorado Gold is fundamentally a Skouries story. This gold-copper porphyry project is widely recognized as one of the most attractive undeveloped deposits in Europe. Its successful commissioning will not only increase Eldorado's gold production by over 30%, but will also introduce a significant copper revenue stream, transforming the company into a diversified producer. As of late 2025, Skouries has reached 73% completion for Phase 2 of construction. When factoring in the infrastructure already in place from Phase 1, the project is nearly 86% complete. First production is scheduled for the end of the first quarter of 2026, with commercial production following in mid-year. This timeline is critical because it coincides with a period where copper supply is expected to be structurally constrained. The project is designed to produce an average of 140,000 ounces of gold and 67 million pounds of copper annually. The second-order implication of this production mix is that Skouries will act as a natural hedge.
In periods where gold prices soften, the copper revenue could provide a stabilizing effect on the company's margins.
Construction progress at Skouries in 2025 has focused on the critical path, including the filtered tailings plant and the primary crusher building. The company has navigated labor market tightness in Greece by accelerating non-critical path work and transitioning to an owner-operator model for the open-pit mine. This shift is a strategic masterstroke. By purchasing its own fleet of CAT 777 haul trucks and loading units rather than relying on contractors, Eldorado has gained greater control over its production schedule and cost structure. The successful execution of the first underground test stope blast in October 2025 confirms that the underground development is proceeding in tandem with the surface infrastructure. With approximately 350,000 tons of ore already stockpiled, the company has ensured that the mill will have a reliable feed as soon as the commissioning process begins. Funding for Skouries is fully secured through a combination of the company's $1 billion cash position, remaining drawdowns on a €680 million project finance facility, and the strategic equity partnership with the EBRD. This robust financial position allows Eldorado to absorb the $143 million capital cost increase that was announced in early 2025 due to labor inflation. Unlike many of its peers, Eldorado does not need to return to the equity markets to finish its flagship project, which prevents further dilution for current shareholders at a time when the share price is beginning to reflect the project's intrinsic value. Mineral reserves and resource management. A mining company's valuation is inherently linked to its ability to replace the ounces it mines. Eldorado Gold's 2025 Mineral Reserve and Mineral Resource Update revealed a company that is successfully offsetting depletion through aggressive exploration and conservative modeling. Proven and probable gold reserves reached 12.5 million ounces by September 30, 2025, a 5% increase year over year. This increase is particularly notable because it was achieved using a conservative gold price assumption of $1,700 per ounce, which is significantly below current spot prices and even the company's peer group average for reserve modeling.
The primary driver of reserve growth in 2025 was the Lamaque complex, where reserves increased by 25%. This growth was primarily due to the addition of the Ormaque deposit and the successful conversion of resources to reserves at the Triangle mine. The ability to grow reserves in a Tier 1 jurisdiction like Canada is a high-value achievement, as these ounces typically command a higher valuation multiple from the market due to the lower jurisdictional risk. Furthermore, the company reported an 11% increase in inferred mineral resources, totaling 8.2 million ounces, which provides a deep pipeline for future reserve conversion and mine life extensions. In Turkey, Kışladag and Efemçukuru have demonstrated remarkable resilience. At Kışladag, design changes and positive drilling results have helped to offset a significant portion of the yearly depletion, maintaining a mine life that extends into the late 2030s. At Efemçukuru, the focus has shifted to the Kokarpinar and Bati vein systems, which continue to deliver high-grade results. The strategic implication of these results is that Eldorado is not just a growth story, it is a sustained production story. The company is not liquidating its reserve base to fund its growth. Instead, it is expanding its mineral foundation even as it invests heavily in new projects. The divestment of the Certej project in Romania in late 2025 is a critical part of the resource strategy. By selling a non-core asset to the Varvara Development Group for up to $30 million, Eldorado has removed a project from its portfolio that faced significant permitting hurdles and required a no-cyanide approach. This sale allows the company to refocus its technical and financial resources on its core hubs in Canada, Turkey, and Greece, where the potential for value creation is higher and the path to production is clearer.
Financial performance and capital allocation. Eldorado Gold's financial performance in 2025 has been characterized by strong cash generation from its operating mines, which has been reinvested into the Skouries construction. For the third quarter of 2025, the company reported adjusted net earnings of $82 million, or 41 cents per share, on revenue of $435 million. These results were driven by an average realized gold price of over $3,500 per ounce, which provided the margins necessary to offset rising costs. Cost management has become the primary challenge for the company in 2025. Consolidated all-in sustaining costs reached $1,679 per ounce in the third quarter, significantly higher than in previous years. This increase was driven by three main factors: higher royalty expenses in Turkey, lower byproduct credits from Olympias, and persistent labor inflation. In Turkey, the government's sliding-scale royalty regime means that as the gold price rises, the state's share of the revenue increases proportionally.
At current prices, this represents a significant headwind to margin expansion. However, the insight for investors is that these costs are primarily price-linked. If the gold price were to fall, the royalty burden would also decrease, providing a measure of downside protection for the company's cash flow. Eldorado's liquidity position is a major competitive advantage. With over $1 billion in cash and cash equivalents as of September 30, 2025, the company has one of the strongest balance sheets in the mid-tier sector. This cash position was augmented by several strategic moves, including the sale of its position in G Mining Ventures for $155 million and the receipt of deferred consideration from the 2021 sale of the Tocantinho project. This war chest ensures that the company can navigate any further cost overruns at Skouries or operational volatility at Olympias without compromising its growth strategy.
The company's capital allocation strategy is now shifting from a heavy investment phase toward a shareholder return phase. Management has signaled that the introduction of a dividend is a priority for 2026 once Skouries achieves commercial production. This is a crucial signal for the market, as it indicates management's confidence in the company's future free cash flow generation. In the meantime, the company has utilized its normal course issuer bid to repurchase shares, signaling that it views its current valuation as an attractive entry point. The transition from a company that consumes capital to one that returns it is the hallmark of a successful mining investment. Macroeconomic environment and commodity outlook. The valuation of Eldorado Gold cannot be viewed in isolation from the broader commodity markets. The outlook for gold and copper through 2026 and 2027 is overwhelmingly positive, providing a favorable tailwind for the company's expansion. The gold market has entered what many analysts describe as a structural bull phase. Prices reached multiple all-time highs in 2025, supported by central bank diversification away from the US dollar and toward hard assets. Major financial institutions, including JP Morgan and Goldman Sachs, have raised their 2026 gold price targets toward the $5,000 per ounce level. The drivers for this demand are not merely cyclical, they are geopolitical and fiscal. As global central banks, particularly those in emerging markets, continue to increase their gold reserves, a firm floor has been established for the gold price. For a producer like Eldorado, every $100 increase in the gold price adds millions of dollars to the bottom line, providing significant operating leverage.
The copper market is equally compelling. The demand for copper is projected to double by 2035 as the world accelerates the deployment of electric vehicles and renewable energy. However, the mining industry has struggled to bring new supply online due to declining ore grades and increasing permitting challenges. Skouries is one of the few significant copper projects coming online in a stable jurisdiction in the next 24 months. As a result, Eldorado is likely to benefit from a premium valuation as it begins to produce copper. Analysts suggest that the copper price could head toward $12,000 per metric ton as structural deficits emerge in 2026. This would make the copper produced at Skouries some of the most profitable in the world, further enhancing Eldorado's cash flow profile. The broader macroeconomic risks, including potential US dollar vulnerability and persistent global inflation, also favor an investment in a diversified miner like Eldorado. Gold and copper are both effective hedges against currency debasement and inflationary pressures. By owning a company with high-quality assets in multiple jurisdictions, investors can gain exposure to these commodities while mitigating the risks associated with a single commodity or single-country investment.
Cash flow. Eldorado Gold's cash flow profile is currently at a major inflection point, characterized by strong underlying operational performance that is temporarily obscured by the final intensive capital phase of the Skouries project. In the third quarter of 2025, the company generated $183.5 million in cash flow from operating activities before working capital changes. Consolidated free cash flow for the same period was negative $87.4 million, a figure driven primarily by significant growth capital expenditures. However, when excluding the specific capital spending at Skouries, the company's existing operations generated $76.9 million in positive free cash flow, demonstrating the robust profitability of the producing assets. The company maintains a strong liquidity position to bridge the gap to full production at Skouries, with $1.04 billion in cash and cash equivalents as of September 30, 2025. This cash balance has been bolstered by strategic divestments, including the sale of shares in G Mining Ventures for $155 million. Total growth capital for 2025 is projected to reach between $440 million and $470 million for Skouries, alongside $245 million to $270 million for other operations. As Skouries transitions to production in 2026, the company expects a significant shift toward positive free cash flow, which is anticipated to support the introduction of a dividend in 2026. Valuation and comparative analysis. As of December 2025, Eldorado's PE ratio is approximately 19.5x. While this is an increase from its 2024 levels, it remains more than 50% below its historical 9-year average. More significantly, the company trades at approximately 0.52 times its price-to-net asset value, or P/NAV, and 3.3 times its estimated 2026 EBITDA. This is considerably lower than the intermediate peer averages, which typically trade at 0.81x P/NAV and 4.4x EBITDA. This valuation discount is largely a vestige of the historical challenges in Greece. As Skouries begins production and demonstrates operational stability, this discount is expected to narrow, leading to a significant re-rating of the share price. When compared to peers like Alamos Gold and B2 Gold, Eldorado offers a growth profile. Alamos Gold, while a high-quality producer, has seen its costs rise sharply due to inflation and is trading at a much higher multiple. B2 Gold is navigating significant jurisdictional risk in Mali, which has led to a dividend cut and a loss of investor confidence. In contrast, Eldorado has a fully funded growth project in a recovering jurisdiction, Greece, and a stable foundation in Canada. The company's projected 44% production growth over the next 3 years is among the highest in the mid-tier sector, making it a premier choice for growth-oriented investors.
The institutional sentiment toward Eldorado is also improving. Major funds, including Van Eck Associates and Jennison Associates, have increased their holdings in the company in late 2025. This institutional buying is a signal that smart money is positioning itself for the Skouries inflection point. The company's inclusion in the TSX 30 top performers, reflecting a 238% dividend-adjusted share price appreciation over 3 years, further underscores its recent success and the market's growing recognition of its potential. Wall Street analysts maintain a bullish outlook on the stock as the Skouries de-risking phase concludes. Average 1-year price targets for Eldorado Gold range from $34.75 to $37.22, with some estimates reaching as high as $48.27 per share. The company is forecast to achieve an earnings growth rate of 55.6% per annum over the next 3 years, significantly outperforming the industry average of 18.6%. This growth is underpinned by an expected 33 to 44% increase in gold production by 2027, driven by the commissioning of Skouries, and a forecast annual earnings per share (EPS) of $4.48 for 2026. Risk assessment and mitigation strategies. No mining investment is without risk, and Eldorado Gold faces several challenges that investors must evaluate. These include labor market constraints, regulatory shifts, and commodity price volatility.
The primary execution risk is the successful ramp-up of Skouries. The labor market in Greece remains tight, particularly for specialized construction and engineering roles. Eldorado has mitigated this risk by accelerating its training programs for the local workforce and transitioning to an owner-operator model. By developing its own in-house expertise, the company is less reliant on third-party contractors and better positioned to manage its long-term operational costs. The workforce on site reached 2,000 people in late 2025, and the company has demonstrated an ability to manage this large-scale ramp-up effectively. Geopolitical risks in Turkey and Greece remain a factor. In Turkey, the centralization of permitting and the expansion of royalties are headwinds to profitability. However, Eldorado's long history of successful operation in the country and its ability to maintain high-quality relationships with local and national authorities provide a measure of stability. In Greece, the company's focus on ESG and transparency has helped to build a social license that was missing in previous decades. The use of filtered tailings and parallel rehabilitation are not just environmental choices, they are strategic business decisions designed to prevent the localized opposition that halted the project in the past.
Operational risks at Olympias and Kışladag are also present. Mining is technically challenging, and unexpected equipment failures or metallurgical changes can impact production. Eldorado has addressed this by maintaining a strong liquidity position, which allows it to absorb short-term operational setbacks without impacting its long-term strategy. The company's robust hedging program also provides a safety net, ensuring that even in a volatile price environment, it will have the cash flow necessary to meet its obligations and finish its construction projects. Strategic synthesis and conclusion. Eldorado Gold Corporation is a company in the final stages of a profound transformation.
The journey from a company burdened by historical challenges in Greece to a premier gold-copper producer has been long and difficult, but the resolution is now in sight. The Skouries project is the definitive catalyst for this change, offering a combination of scale, grade, and commodity diversification that is rare in the mid-tier sector.
The investment thesis for Eldorado is built on three pillars: a robust and growing mineral reserve base in established jurisdictions, a transformational growth project that is fully funded and nearing production, and a favorable macroeconomic environment for gold and copper. The company's current valuation does not fully reflect the earnings power that will be unlocked once Skouries reaches commercial production in mid-2026. As the execution risks continue to fade, the market is likely to re-rate Eldorado toward its historical multiples and its peer group averages. Furthermore, the company's move toward a dividend policy in 2026 signals a new era of capital discipline and shareholder alignment. For investors seeking exposure to the precious and critical metal sectors, Eldorado Gold offers a unique combination of stability, growth, and value. The company has successfully navigated the sweet spot of the mining lifecycle, transitioning from a high capital development phase to a high margin production phase. As the world enters a period of structural commodity demand and geopolitical uncertainty, Eldorado Gold's diversified, high-quality portfolio is exceptionally well-positioned to deliver sustainable value to its stakeholders for decades to come. The shift toward copper production at Skouries is perhaps the most undervalued aspect of the company's strategy. By 2027, Eldorado will be one of the European Union's largest copper producers, providing a domestic source of a critical metal that is essential for the continent's industrial and environmental goals. This strategic positioning provides a layer of geopolitical relevance that few other mid-tier miners can match. It ensures that Eldorado is not just a participant in the mining industry, but a critical player in the global energy transition.